The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. David, today we join you. You're passing through the airport there in Newark on your way to New Orleans. You're there basically to meet with people. You do this once a year. Louis Lehrman, Van Hoisington, Pierre Lassonde, guys who don't normally necessarily just give presentations, come together once a year and talk about these things. David, I know you have to catch a plane here in a few minutes, but I'd like to grab a few thoughts on what you heard today.
Kevin, I have the belief that iron sharpens iron, and there is the need to rehash certain assumptions that you may have and assess them from a different vantage point. And so whether that is hearing information or viewpoints that conflict ideas that you may hold dear, or listening to experts who you perhaps do agree with, both are important. And sharing ideas, asking questions with a number of the gentlemen that you just mentioned. I've had conversations with them today and listened to presentations relating to the bond market, relating to the gold market, relating to the equity market, and some fascinating observations that I have sort of distilled from those conversations and just listening. So beginning with Louis Lehrman, of course, we had mentioned this in last week's commentary. He wrote a book on restoring the gold standard, and this is where he's particularly critical of our monetary system the way it exists today, looking at living through an age of inflation, starting in 1914 and the end of the European state system. When we went into World War I, the world had to finance its new expenditures. Wartime financing could not have been done on the gold standard, and so the world left it for the first time since the 1860s, kind of covering old territory here because that was the majority of our conversation here in recent weeks. But really what was interesting from this conversation was his sort of moving forward in time and saying, listen, we are the creator of problems. The U.S. system, the monetary system based on the U.S. dollar, is responsible for transmitting destabilization around the world, and we need to own that before we start casting aspersions on the Chinese or assuming that they're responsible for instability in the world monetary system. Let's look at our balance of payment deficit, and let's look at the amount of inflation we have transmitted around the world. Clearly, one of the observations made, and again, perhaps more relevant to us today than observations relating to 1913, 1922, 1932 and 33, 1944, all dates that we discussed in detail here recently. The inflation, which has been a major issue around the world and has led to the Arab Spring. He certainly was dogmatic about the fact that this had nothing to do with some sort of humanitarian plea on the part of someone in Tunisia setting themselves on fire. It had everything to do with food and fuel inflation. This had everything to do with instability that is created by our world reserve currency status and the transmission of inflation via these dollarized markets.
David, wouldn't you say that a lot of that's caused because 75% of the world actually has to use dollars? I mean, we can print our own, and that keeps it to where we're basically borrowing from ourselves. But other countries, as we print that money, they really are affected by the inflation, and that's the majority of the world.
You're exactly right, because it is food and fuel that 75% of the world references the dollar in terms of buying and selling. So clearly, whatever the dollar does, you're seeing those real goods and services repriced. It takes more of them to buy the same stuff needed. And this is particularly relevant to subsistence economies. This is particularly relevant to your less developed countries or your emerging markets, where they kind of are on knife's edge anyways, because they're spending greater than 50% of their income on these two items, food and fuel. So even a marginal increase in those, given the inflation that we transmit via our very aggressive monetary policies, is destabilizing. Destabilizing politically because, again, if you can't feed your family, you tend to take to the streets and protest and say, hey, listen, this isn't quite right. I am frustrated. So there, at this point, is no dollar alternative in the world monetary system. But there certainly is a growing desire for something to change because it's not working. Now, it's working just fine for us, but all that to say, there's a large swath of the world that it's not working for, because they're at the end of something that feels like social injustice. And they may not be connecting the dots between what they're experiencing and a dollarized world, but that is, in fact, what they are, and this is what Lehrman was pointing out. This is what they're responding to.
David, we're about to go into 2013. If we were to roll back 100 years from 2013, there was a critical document that John Maynard Keynes wrote that probably changed the course of history over the last century. I know Lehrman has pointed this out in the past, but would you elaborate?
Sure. 1913, published was an article called Indian Currency and Finance, and this is what Lehrman was discussing. And in this paper, John Maynard Keynes sort of anticipated what would be the intellectual stance taken in 1922 at the Conference of Genoa. And I quote, he said, "It's a matter of comparative indifference," end quote, this notion of having gold or foreign exchange as a part of the reserve assets. In other words, it just doesn't matter. You can have gold, you can have British pounds, you can have U.S. dollars, which is exactly what they adopted in 1922. But the intellectual backdrop for that 1922 decision came from 1913. Now, fast forward, as you were saying, 100 years, and we have, as a direct result of a dollarized system, incredible instability in the world. Now, one of the things that Lehrman pointed out was that on about a 30-month lag, you have, following rapid expansion of the world dollar base, major moves in oil. And his assumption is that sometime in the next 12 months, maybe even sooner, we do see prices start moving up. Again, if we're talking about a 2013 to 2015 time frame, think of the implications here because, again, massive moves in oil reprice almost every good and service because, again, if you just simply want to buy cucumbers at the local store, guess what? Those cucumbers and any other produce have to be delivered. And if they're delivered, the transportation costs matter. And if the increase in transportation costs tied to an increase in oil, you see, this is actually very relevant to things that you would take for granted. Why are things more expensive at the grocery store? Yes, indeed, this lag of 30 months between rapid expansion of the world dollar base, minimum, to as much as $3 trillion, and that's already baked into the cake, leads to a major move in oil prices. And I think that's relevant for investors. I think it's relevant from a growth thesis. I think it's also relevant from sort of an insurance thesis. What are the ramifications, again, in terms of political volatility and social volatility as a result of inflation driven by an increase in oil prices? And really the root cause is that rapid expansion of the dollar base.
David, something that's confusing. The markets are throwing confusing signals. We have signals that show that we may have oil inflation coming and we may have higher interest rates. But, there are other things that we have to consider. If we have higher interest rates after this 100 years of debt expansion, we know that the government can't afford the interest payments already. We've talked about before if interest were to go up. Now, you had listened to someone today, Van Huizington is his name, who basically laid out the possibility of another multiple years, maybe 3, 5, how many more, of low interest rates being artificially held low but not actually going up.
Listen, the presentation by Van was the best presentation I have ever heard supporting a deflationary case. And, very simply, this is a guy who has been long the 30-year Treasury bond since 1990 and has made money, not every year since 1990, but if you averaged out his track record, having been long the 30-year Treasury, has done quite well. And what he's looking at is this notion that U.S. private and public debt as a percentage of GDP here in the United States is north of 350%. There's this massive overhang of debt. In fact, when you get to these kinds of levels, it takes a long period of time to unwind what is essentially an over-leveraged, overextended balance sheet. And so this is really the issue. He views this period directly ahead as very similar to what we've had the last couple of years, reduction of rates. He thinks rates can actually go lower from here. The 30-year Treasury at roughly 3%, he thinks can go even lower. In fact, he thought if the Fed were to get out of the way, the market would take rates lower. I've got to tell you, out of 30 pages of notes that he's shared with us, I simply haven't heard a better case for deflation. Of course, as you're quaking in your boots thinking, what are the greater implications of deflation in the context of owning gold or owning silver or whatnot? We'll address that in a minute, because one of the other presentations was from Pierre Lassonde, someone who I consider to be one of sort of the geniuses within the gold space, and he basically completely rebutted what Van Huizington's position was insofar as it's negative on gold. We could, in fact, have a scenario in which we have a very deflationary outcome, and it is not negative for gold. And the combination of these two presentations back and forth, I think, was absolutely brilliant. So, again, the assumption from Van Huizington is that we see slow growth for a very long period of time. In fact, slow growth for the foreseeable future. Is that 3 years? Is that 5 years? Is that 7 years? But essentially, the federal government is completely written out of this script. They can do nothing to increase the money multiplier. They can do nothing to increase velocity. There's nothing that fiscal policy can do and nothing that monetary policy can do at this point. What we have ahead, in Huizington's view, is, again, slow growth and an unwind of debt and too much leverage in the system.
Well, David, even if we have a deflationary outcome, we're still seeing quantitative easing have some effect. I mean, it is bailing banks out, and we have seen stock prices rally whenever Bernanke announces more quantitative easing.
No, and these were stats that Van shared with us. It was fascinating. Again, QE1 led to a 36% increase in the S&P and a 30% rise in gasoline prices. QE2, 24% increase in the S&P, 36% increase in the gasoline prices. And as soon as each one of these periods of quantitative easing was ended, then the CPI resumed a downtrend, and equity prices resumed a downtrend. So, unfortunately, what's really unhealthy when you're looking at the S&P and the stock market today is this dependence on Fed money printing, quantitative easing, 1, 2, 3. Although, as we've said in the past, quantitative easing 3 really hasn't gotten out of the box yet. They've talked about it. They've announced it. They've said we're going to buy $85 billion worth of mortgage-backed securities on a monthly basis from here until the cows come home, but they haven't actually gotten started with that. So one of the things that I think is critical is that in spite of the Fed pushing up prices, real output has actually gone down. They're not doing anything to recover the economy, to create growth in the economy. And so there is really not the desired effect in terms of growth in the economy. All it's doing is passing through to particular asset prices. So asset price inflation, yes, but recovery in the economy, no. And the big 800-pound gorilla in the room is that you can't grow an economy through fiscal policy measures or monetary policy measures when you're essentially at the end of a credit cycle. And I think that was kind of what Van Huizington was getting at.
Well, David, I know you've gone and talked to these guys year after year, and sometimes there is a clear direction. It seems like there's a clear theme, but it sounds like there's a tug-of-war right now, that we're not getting a real clear signal as to what this next year entails. And you spent time with one of the world's greatest hedge fund managers ever. I mean, the guy's worth $4.5 billion himself, much less the money that he managed before he got out of the business.
What's interesting to me, Kevin, is that the number of really sophisticated hedge fund managers who are hanging it up, who are deciding that in the environment of Dodd-Frank, in the environment of re-regulation, that it's very unclear what the capital markets are going to look like a few years from now, and it's simply not worth taking the risks. It's better to just move to the sidelines. Now, that doesn't mean they're moving to the sidelines entirely with their own money. It just means that they're not going to be responsible for other people's money because they don't see wind in the sails. I think that's very critical. Bruce is an interesting guy because in 30 years of running a hedge fund, he's done a couple interviews, but very private, very secretive. It was an honor and a privilege to be able to interact with him today in a larger group audience, of course. But this is a guy who actually would take Van Huizington to task and say, U.S. Treasuries are the clearest negative bet in the world. You just have distortion in price. You don't have equilibrium represented in the current price in Treasuries. You have the whole world dependent on unhealthy levels in terms of interest rates, and we should see mean reversion. Now, Kevin, if you go back to what the Japanese have done, it was so clear in the first 3-4 years of Treasury manipulation or the equivalent of Treasury manipulation in Japan that everyone was betting against Japanese bonds, assuming that rates were going to go higher. And this became known what was the widowmaker trade, where you were betting against bonds, and the question is how much money did you ultimately lose? betting against Japanese bonds because rates went lower and lower and lower and have stayed lower for 20 years. So again, Kovner taking Van Hoyzington to task on this. This really is sort of an intellectual battle, if you will, and no one knows when it's going to happen, when the Treasury market comes unwound. That it will happen eventually is inevitable, but again, the time frames involved are not exactly clear. I think one of the things that was interesting, just looking at Kovner's background, he is a global macro manager. In other words, he really does care about the big picture, and it's harder and harder to manage because you have policies involved which are unpredictable, changes with the current election, and so many things that, again, represent headwinds to managing assets. Kevin was fascinating. Kovner studied political economy at Harvard, and it really is, with some philosophical basis that he reflects and says this is a very tough environment. Judgments being made on Wall Street today are very much like in Plato's Republic, where you walk into the cave, you're looking at the shadows dancing on the walls, if anyone's familiar with Plato's Republic. And at best, you're dealing with some sort of fabrication or distant reflection of reality. How do you, and this is really what sets a money manager apart today, in his opinion, what would give someone an edge today is being able to separate signal from noise. You and I have talked about this over the last few months.
Sure.
But being able to take the sheer amount of information and data and not be distracted by the sheer volume, but be able to find a very clear signal. What is happening? What is your judgment? Doing the hard work to figure out what, in fact, is driving the markets. Not particularly obvious, and that was one of the things that was discussed very openly today.
The person that I'm most interested to hear from, David, of everyone you talk to, is someone who has proven himself through many years, just watching him through the years manage and buy gold mining companies and run them, a man named Pierre Lassonde, and in the industry, it's almost a legendary name. Now, Pierre Lassonde, he always seems to bring a point to the table that other guys have not thought about. What were his thoughts today?
I find Pierre Lassonde to be incredibly intriguing. He has spent, just like Van Hoyzington has spent 40 years in the bond market, Pierre has spent 40 years in the gold market. So arguably, Hoyzington's an amazing guy when you're looking at 30-year treasuries. But if you want to know something about gold, there's probably no one better to be making inquiries of than Pierre Lassonde. I had a conversation with him, and I asked him when he was with Newmont Mining, because he has a long history here. Euro-Nevada, Franco-Nevada. Franco-Nevada's bought out by Newmont Mines. Newmont ultimately looks at their royalty business and what they have in oil and some of their royalties in gold, decide it's not a core asset, and they spin it off. Later, Pierre comes back, revives Franco-Nevada, and buys those assets. And I asked him, why in the world would the current CEO of Newmont do this? And he just kind of shook his head and smiled. And, I'm considering in the back of his mind and translating the silence as one man's trash is another man's treasure. Well, okay, now you've got a company that was worth a few $100 million that's now worth $8 billion in market cap, and Franco-Nevada is a very interesting going concern. Now, all of that is prologue to say what is happening in the gold market today is beyond the U.S. market, is beyond Hoyzington's concerns about deflation. And here's why. The opening comments from Pierre were that we in the U.S. view the gold market from a very U.S.-centric perspective, and that if you take a more worldly view on the gold market, in fact, what you find is a dramatic shift in demand dynamics. Now, Kevin, you and I have talked about this going back a couple of years because it's actually 6 months, 12 months, 18 months ago that we were talking about a shift from the U.S. and Europe to China and to the Indian subcontinent. And lo and behold, this is what all of Pierre's comments were resting on. Supply and demand are what are driving the gold market. And this has to do with very little new supplies coming onto the market. In a nutshell, very little in terms of new supplies coming onto the market, but with expanding demand dynamics, particularly from central bankers and particularly from investors the world over. And frankly, the U.S. investor doesn't even factor in. Not important. So when we're concerned about U.S. monetary policy or U.S. fiscal policy somehow being a drag on the gold market, or even the deflationary dynamics of the U.S. debt system, and again, this sort of deflationary overhang, which Van Hoyzington is so concerned about, it's a secondary issue. It's the sidelight compared to the supply-demand dynamics globally, which have been driving the price of gold from $250 up to 1900 and change. So a couple of the points that he made I think were very interesting.
Well, David, we talked about inflation and deflation, but Pierre Lassonde is saying it doesn't matter. We're talking about supply and demand. Why don't we go ahead and start on the supply side? What does Pierre Lassonde feel that the supply picture looks like? Are we able to produce a lot more gold now that the price is rising?
No, and the problem is that we haven't had major finds since 1993. The last 15 million ounce mine that was put into motion was Yanacocha, and that's, of course, a Newmont asset. But, the reality is we are finding smaller and smaller ore bodies, but nothing that have scale. And that's a significant issue, particularly when any ore body, small or large, the amount of time that it takes to bring them online, it used to be in the early 80s, and Pierre was very specific on this, 2 to 4 years to bring a new project into full production. That was in the 1980s. Now, with environmental concerns and feasibility studies and the whole lot, 10 to 12 years is a minimum, and a number of the projects that your major miners are bringing online are taking up to 20 years to put into production. So the amount of money that you have to spend before you earn a buck out of a given mine is astronomical. So, the profitability obviously is tough for the miners. We're talking about margin compression and other issues relating to that particular area. But really the issue is you can't snap your fingers and make new supply dramatically or magically appear.
So, David, supply side, it doesn't look like it's going to increase dramatically. Now, the demand side, we've talked about this a number of times. The demand is shifting to the east and away from the west, and it just looks like it's increasing. What was Lassonde's view on demand?
Well, this is where it gets even more dramatic because, again, central banks play a major role in this. If you look at the amount of ounces or tons, frankly, that they were selling all through the 90s, and even through the first part of this decade, and then all of a sudden 2009, that turns around, where European banks, considering themselves very sophisticated and not needing this quote-unquote barbaric relic, have sold. And actually, he was the first to point out that Canada was the first central bank to liquidate assets in the form of gold back around the turn of the millennium. And then the British. Of course, that's the most notorious. And then the folks in the Netherlands did on the third time around. But that was sort of marking the bottom of the market. We continue to see liquidations by central banks through 2009. And now we're consistently seeing major purchases, and it's primarily your BRIC countries, Brazil, Russia, India, China, anyone who's sitting on massive dollar reserves. Again, these are originally trade surpluses that now represent massive foreign currency reserves, mostly in the form of dollars. They're not happy sitting in dollars alone. They'd like a little bit more diversification, and we covered this with McAlvany a few weeks ago. Relative to their reserves, they have a very small percentage sitting in gold. So Europe is sitting with 30, 40, 50% on average of their foreign currency reserves sitting in the barbaric relic. These emerging markets or less developed countries have closer to 2 to 4%, and they'd like to see an increase. This is where it gets tricky because if you had Thailand, Indonesia, Taiwan, South Korea, Japan, India, China move in line to what the World Gold Council suggested originally a few years ago was a normal number, 15%, well under the European average and well above the current developing market average, you'd be talking about 17,000 tons. Just those countries that I mentioned, 17,000 tons would have to be purchased in the open markets. Kind of hard to get that done. On the other side, you've got investor demand moving up. And this is not people buying jewelry. It's people buying gold bars and gold coins for the purpose of offsetting losses. And a lot of this does have to do with inflation, but there's other considerations as well. Being in a negative real return environment, inflation is only one component of that. If you have a negative real rate of return, which is going back to Van Huizington's point earlier, if we're going to see low rates of return in the bond space for 3, 5, 7, 10 years, and there's even a marginal rate of inflation, then your real rate of return is flat or negative. And again, going back to the Summers-Barsky thesis, that's the perfect scenario for investor demand to continue to increase. And the assumption there is that moving back to numbers that we saw in the 1980s in terms of investors buying gold as some sort of an insurance policy against inflation, against deflation, against geopolitical instability, current numbers are at about 3.5% to 4%. Again, this is looking at gold's share of global allocations. It's very, very low. To go back to the 1980s numbers, or even earlier, the 1970s numbers, it was closer to 14%. Gold used to play a very significant role in European asset managers' asset allocation models. Even it became popular in the 1980s for U.S. money managers to suggest a certain percentage in gold, as much as 5, 10, 15%. 14% was the average coming into the early 80s. We're currently less than 3%. If we just bumped that number to 5%, says Pierre, you're talking about demand to the tune of 66,000 tons. So when he steps back and says, well, okay, Van, you may be right. We go into a deflationary scenario. Rates are low for a long period of time as we deal with too much leverage on the balance sheet. Don't know that that's going to impact the gold market, given the fact that we've got demand on the increase and we've got supply dwindling. The supply-demand equation is ultimately what's driving the price of gold, period, end of story. It's not inflation. It's not deflation. It's not geopolitical instability. It's just a migration of already existing assets, not newly created bank assets, but already existing assets that are either looking for a new home in the form of investment dollars or central banks looking for a new monetary alternative without the same liabilities or credit risks or counterparty risks that are associated with other investment options that they have.
Well, David, they're probably boarding the plane right now if I know you, because just like your dad, you guys always are the last guys on a plane, so we're going to have to wrap this up. But I love when you meet these guys, I can hear the synaptic connections and the axons firing, and, it's always stimulating, Dave, and I think it really adds to your ability to analyze, to be around these guys. Now, you're just about to hop on a plane to New Orleans. I know you're going to be speaking there. Could you give us just a couple of closing thoughts and let us know what you're going to talk about in New Orleans?
I'll have to do it faster. I'm going to miss my plane. But New Orleans will be meeting with, again, a number of people that sometimes we agree with and sometimes we disagree with. Having dinner with Rick Rule, Robert Prechter, and a number of folks that on the bearish side and the bullish side in terms of commodities don't see things eye to eye. That's the perfect environment to hash out ideas. And that's the kind of environment, I guess maybe I'm favoring sort of my philosophical roots and saying, let's take both sides of the argument and argue as effectively as we can, see what we come up with in terms of a conclusion. Again, thesis, antithesis, and synthesis, that's what we're driving towards. And with that, Kevin, I've got to go.
Have a safe flight. You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, McAlvany.com, or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.